Good morning. My name is Adam Cotton and I'm the Rational Investor. Let's talk about retirement. How much money do you need to retire? What do you need to retire? Where do you need to be? What's the timeline and everything else? I've been seeing a lot of videos out there talking about a stock, JEPI, or I always call it Jepi, giving recommendations that you can just buy that for retirement and get a 10% dividend yield and use that for the days you retire. Now, for those of you who don't know what that is Jeppy does a covered call strategy, which you could also learn and do on your own. And I'd be a little cautious about this advice that the people are giving because they do have risk. And to be fair, any stock or EFT or sorry, ETF or anything of that nature that pays a 9, 10, 11 or higher dividend, they are taking risk to do that. In Jeppy's case, if the market goes up, they're probably not going to go up a whole lot in value because they've sold calls against the things they're buying. And if the market goes down, they're probably going to take a hit in their stock price for the same reason. When you sell covered calls, you've bought something and you're selling an option against it so that if the market goes up, you get taken on those calls. And if the market goes down, you still own that underlying commodity and you've collected the premium for the call. So if they're buying the spiders or the Qs or something like that and selling calls against it to earn their 10% income, if the Qs or the spiders go down, they still own that underlying property. They've collected the premium for selling the calls against it, which is how they're able to pay that dividend, but they are still taking the downside risk of the things they own. So I would be a little cautious about putting somebody's entire retirement portfolio into something like that because people aren't going to realize the risk that they're taking. Now, that being said, so you guys know I'm not a financial planner. I'm just some idiot on YouTube giving my advice from my experiences over the year. You use it for entertainment purposes. Don't use my information for anything other than that. I would suggest that you take the time to learn about these products and learn what they are, make the right decisions on what fits what you need for retirement, or work with a financial planner who does these things for you. Now, anybody who would like, I think I have the best financial planner in the world. It's not sarcastic, I really do. I manage most of my money myself, but I put a good portion with him. I put about 50% of what I put in the equities there because I don't want to touch them. And what I love about the account that I have with my planner is that there's no online trading. I mean, I can take a look and see what's in my account, but I don't have access to it. And that's really what I want for the purposes of things that I do for my retirement. I want to pick what I think are great companies, and I'm happy to share any of those with people as well. But I want to pick what I think are the best companies because I think that gives me the best chance of being in the best position when it comes time to retirement. I don't want to just rely on a big dividend. Now, I do have some of the companies that have big dividends, but I wouldn't put it all in Jeppy. And even if I own Jeppy, which I don't, but it's one of the ones I've looked at, which is why I'm familiar with it, I have no problem owning Jeppy, but I would mix it up with PFFA. And boy, I really like one called OHI because of what they invest in, or NLY. I mean, there's tons of them out there. I don't know why YouTubers seem to be hooked on Jeppy and the Schwab fund, but they just do for some reason. And then I would take a certain percentage of my portfolio and put it into those products. But I also wouldn't want to not own things like Amazon or Apple or Meta and things that may not pay a dividend because I think they give me the best chance for some upside movement. And while may have some ups and downs, if the dividend companies have issues, they may end up having to cut their dividend or the stock price may go down or all sorts of things that people may not be prepared for. Risk of markets is risk of markets, and trusting the information out there, not understanding that there's actual risk in those products, is a huge mistake. And I would hate to see somebody to put a huge portion of their portfolio into one item because it pays a high dividend. I did that years ago. I found this stock called YLD, And I guess it's why I share the information, because I've made a lot of these mistakes and followed the advice or thought a dividend was a guarantee. Well, YLD back in the, I don't know, it was probably early 2000s if I were to guess, but I don't remember the exact dates. They were a high yield fund and they were paying 9, 10% when rates were only 6. Well, YLD ended up going to zero and going out of business. So how good is the 10% dividend when it's poorly managed and the company ends up going out of business? And that's the stuff that people don't always realize can happen with some of these funds. It's not a guarantee. Now, there might be a good chance they might have great people running them, they might be well managed, but there is risk in every type of investment. Even a CD has some risk to it, even though it's close to zero, or treasuries. I mean, the US could default on their treasuries. I don't see it happening, and I think that's as close to a zero risk product as you can find. But I'd rather see somebody pick 20 companies that they think are the best of the best and make sure they're spread out into different fields. The ones that I mentioned with Meta and everything else, I wouldn't want to see everybody in all tech. Archer Daniel Midland, they're a wonderful company. Caterpillar's a great company. And if the economy slows, Caterpillar could have a big dramatic fall. At the same time, they're pretty unique in their field. I'd want to see people having some health care and being spread out into different sectors and putting their money into things they think are really good. And don't take too many shots. I mean, sure, take a shot with a tiny amount of money if you want. See if you get lucky. But here's the problem. Let's say you buy the next Tesla, the company that just runs and runs and runs and goes to a zillion dollars from a really low price. The odds that you put enough of your money into that one stock and held it as it went all the way up is beyond small. Like, the odds of really sticking with something as it grows and grows and grows, it's not realistic. If you buy $10,000 worth of something and it goes up to $1 million, what are the odds you didn't shrink that position down along the way? Now, that doesn't mean I'm giving advice to just hold it, but I would be much more comfortable with Meta if it starts to have something like that happen and their earnings are still going up and I'm still comfortable with the company. I'd rather pick 20 really good companies and kind of stick with them for 10 or 15 years and know that I'm comfortable if Archer Daniel Midland quadruples or quintuples over the first 3 years and I just get that lucky, that I still think they're a great company and I'm able to stick with it. Johnson and Johnson, or odds are these companies don't have those types of moves. They're probably a little bit more boring. But if we're talking about retiring and getting in the right position, I don't know that you want Shopify, Snowflake, Zoom Video, and all of these high flyers that make the news and sound exciting. It's just not the way to set up for retirement. And if possible, I would spread into some real estate and I would spread into some collectibles and all the things that people talk about having a diversified portfolio. At the same time, at least me personally, I'd rather see if I can pick the companies that I think will outperform and get lucky, instead of being so diversified that all I get is the market moves. I don't really just want to own the ETFs. I'd rather pick the companies I think are best. So be happy to share the ones I think are best. I got a big enough ego to think that way. But anyway, do me a favor, like, subscribe, give me a comment, let me know what you guys think. Happy to help any way I can. Again, if you guys want me to share the financial advisor I use, it's my brother, so I really trust him. But same thing, he has the same background as me. He traded at the Chicago Board of Options for a long time. When they went from eighths to pennies, he pretty much left because it changed their dynamics. I used to trade at the Mercantile Exchange where I traded currency futures. He went into financial planning. I went in to manage my own funds and kind of do other things. So anyway, give a shout out. Hope you're enjoying your day, and I'll talk to you guys tomorrow.